Why am I having problem? Okay, recording has started. So, afternoon, everybody. So, welcome to this class. Okay. So, we will start with mentioning, right? 3 to 6. Today is the 14th. Okay. Next week, no class, because it's a public holiday for Hari Raya Puasa. So, the week after that, 28 is your last class. Okay. So, next week, don't come for class. And I remind you, you must do 3 type of coursework. And coursework to be uploaded to this file. Deadline is 20th of March. And when you upload, please put your name and the type of coursework. Okay. Maximum 4 person per group. You can send in 1 person also can. 2 person as a group also can. 3 person as a group also can. 4 person as a group also can, but not 5 person as a group. Okay. Now I got some news for you, and that's what happened in the yesterday. We have our university meeting, Senate meeting, and we were told uh, basically to do student assessment. We got type A and type B. Type A is thing we call coursework. That is due during the course. Type A. So it composed of assignment, presentation, and case study. These are the mark 30, 10, and 20. So coursework is 60 marks. The final exam will be 40 marks. Now, the date of the final exam will be informed to you later. It should be quite close to the end of the semester. Okay. So this one, you need to submit by 20 of March. So let's look at the marks. So what the standard has said is that if out of here is 60 marks, you need to pass 30. And for the final exam, you need to pass 20 out of 40. In other words, if you only do well here and you do nothing here, you fail. Because any A or B fail, then fail. Even if the total combined is more than 50. What I mean is, like, for example, here you got 60 and you need to pass 30, you only get 25, right? But here 40, you do very well for the final exam. 30, you add up is total 55, but that should be passed, isn't it? But now the standard say you will fail because they want at least both type A and type B to be passed. Okay, type A and type B must minimum pass. So the other way also can. Let's say, for example, type A out of 60, you get very high 50, right? And final exam out of 40, you fail, you get 15. So even though you got 65 marks, we treat that as a fail because you must pass A and B. Okay, is that understood? Say something.
Understood.
Yes,
Understood.
Okay. So that means is, sometimes, what I see, sometimes you got here 51, right? And here you got 0. So total is 51. And they say, hey, sir, why can't I pass? Well, because you didn't attend final exam. Okay? You didn't attend final exam. That is not allowed. Okay? Now, what happens if you fail? You can take again. You can take again. And we call that, I think, supplement. And you have to pay, I think, 150. So let's say if you take again, the maximum mark you get here is, I think, 52. That's all. And this will be considered as 0 if you take again under supplement. Supplement, like supplement vitamin pills. So we supplement examination. Okay. So for supplement, you may have to pay actually $150. Okay, so I don't encourage you. So I encourage you to, unfortunately, to study more and make sure you pass. So here, 50 will be okay. Okay, here 50 will be okay. You understand? Okay, so this is very clear. It's recorded, so you are now be well informed. Okay, now next I want to talk to you is about the WhatsApp. Now I have put the link for the recording of last week class. Anybody having any problem to access this link? So if you just click here, open link. So this was the last week class. It's on YouTube. It takes a long time because it's 2 hours something. That was the last week one. Okay, you can see my clothes is different. Okay. Okay. Now, so far any question? Because I think we have done chapter 1, 2, and 3, right? Any question? You have to do a lot of reading at home, unfortunately. Okay, so today we will at least do 4, 5, if possible, up to 7. Now, as what I tell you last week, here I not supposed to be teaching you 100% from the slide. I want you to have communication, okay, with me, and also share your communication with your fellow students. Okay, so we will start with chapter 4 first, and I'll go through quite fast so that we have enough time, right, for some general discussion. Okay, now class monitor, can you see this slide? Healthcare financial statement analysis. Class monitor? You don't know who's a class monitor? I selected already.
Can see, sir. Can.
Who is the class monitor? Who is the class monitor? Wait, hang on. Shaima, isn't it?
Yes,
Shama.
Doctor. I'm here.
So you're the class monitor. So whenever I ask question, the rest of you very shy or not around, so they don't answer, you have to answer. Okay?
Okay.
Yes, you are the class monitor. Thank you very much for your volunteer. Okay? Okay, today we'll look at the chapter 4, healthcare financial statement analysis. Okay. We start with the balance sheet, income statement, and cash flow. These are the three main. This document need to prepare at least once a year. Okay. The balance sheet and the income statement must be lodged with the government. Okay, it's going to be open document. Anybody can go to the government. In this case, is the SSM, Suruhanjaya Syarikat. Okay, Malaysia. That's in Malay. Or the registrar of company. This is English. Okay, every state would have one. If you want to know the address, go to internet and Google for SSM and your state name. It will show you where is the address. You go there and if you have the company registration number, right? Every company got registration number. This registration number must appear in their invoice, must appear in their the card, introduction card, must appear in all of their official documents. So once you have that number, you go to SSM, tell them what you want, balance sheet, income statement for how many years. Okay, it's a small sum to pay, and you can access to any company. Okay, by their code, registration code, or SSM registrator, nombor pendaftar. Okay, so you can see their balance sheet and income statement. Cash flow is an internal document. Okay, so first, Your financial statement, the balance sheet income statement, allows various stakeholders to assess. That means when they see the documents, they can judge the health of the healthcare entities. Okay, so by looking at the financial health, we can have insight. How is your resources being used? And well, we want to know whether you're making profit and loss or not. They also want to know whether you can have enough money to pay people. So these are the two statements. At least you must do it once a year. So it's actually a snapshot of the resources. Like for example, what kind of asset you have. Maybe how much is car, how much is land, how much is building, and so forth. And also will show you your profitability, okay, for that particular year. So, but if you're looking at trends of sales, trends of profitability, or trends of the assets and liability, you don't print 1 year, you can print a few years, okay? It doesn't take long because all these are computerized in the SSM or ROC. So, but you have to pay a little bit of money. I cannot remember how much because the price does fluctuate, but it's not much, okay? So you use this kind of document for strategic decision. So the bank will look at this document to think whether they can lend to you or not. The potential investor will want to look at it whether they want to invest more, or if you are a public listed company, people want to buy shares or sell their shares of your company, they will use this kind of documents. Okay. Now, this is the first one, the balance sheet. You got asset classification. So, and they also got the liability and equity. We give you an example. This is the balance sheet. Now, wait, sometimes we use the word consolidated because maybe you are a main company. You also got some other small company that you own. So we consolidate as a group to see the total group. Okay, let's say, for example, Nestle has got one company selling Milo. Nestle also got another company selling Nestle instant coffee. So two companies. So by right, they will be consolidated as a group to show you total Nestle financial statement. Okay, that's why we use the word consolidated. Now, sometimes they will show you 2 years. If they only show 1 year, then you have to pay for the second year data. So these are the type of assets, current asset, cash, or whatever it is. And this is the other type of fixed asset. What's the difference? This asset will be turned over at least one time in a year. Now, the other things like land, building, equipment, you don't sell and buy. Okay, you don't sell and buy within 1 year. Right? Now, what happens if you are a company that's dealing with selling of buildings, selling of cars? Now, if that's the case, those assets will be under your current asset. Okay, because you are doing that business of selling land or selling buildings. Okay, you buy land and you sell land. This will be under your current asset. It's those assets that you do not sell, so within 1 year, so this is called the fixed asset. Depreciation, I'll talk about it later. This is basically reserve money to replace this fixed asset here. So this is the current asset total. This is a fixed asset total. So this is the depreciation, keeping money so that you can have enough money to replace these assets because they get wear and tear, like for example, building or equipment or land. It may be a not freehold, leasehold, 99 years, so you need to depreciate. So this is a total. This is a total company asset, plus maybe your company got some other investment. Your company may have buy shares in some other company. So this is the total asset. What does that mean? It means 45, okay, 45 million is the asset of this company. Now, the other side of the coin is what you owe people. It's also 45. Okay, so you owe people because of some current liability, you have not paid some people some money, or some debt that you have to pay back within 1 year. All this is within 1 year, you have to pay. So current asset is the opposite by current liability. Asset that you use within 1 year to generate income, and liability within 1 year you must pay back. Okay. Then you have all the other long-term asset, more than 1 year one. You will pay, not now, you're paying more than 1 year later on. And then you got the shareholder equity and non-current. So you add up all this, will become 45K. So what are we saying? We are saying the total asset of company is 45. And this 45 is financed. Okay, I repeat, this 45 asset is financed by what you owe people. Current, long-term, shareholder equity or deficit. That's why it comes 45. Okay, you have to see from that point of view. The company got certain asset, but this company is this asset is financed by liability and shareholder equity. Okay, so what do we want to see? Well, basically, we want to see you have a lot of cash because you need to pay people, and you should not have so much liabilities. And let's look at it. Here got 7757. That is your current liability. Need to pay within 1 year. Your asset here is 11. Right? So not so bad. Right? But when you look into detail, you need to pay people cash. 7.7. Okay? But your cash is only 621. A lot of this 11 is actually account receivable. What is account receivable? You have done some sales, but you have not collect the money back. That is called accounts receivable. This is a huge amount. So if you have problems in collecting this amount, therefore this will not be 11. It will be maybe 3 something, 621 plus 18 plus 13, 37. If it's 37, how are you going to pay what you owe people? That's what we look at. Okay. Now the next one, why is people owing you increasing? You're having more sales and you never collect the money. Okay, that may be one. Or maybe your company something wrong, never chase money that is owed to you by your customer. Either way, why are you increasing? Okay, so it's not so good. Okay, it's not so good. See, cash is increasing by 120, but what people owe you is increasing by maybe 600. Right? So it's not a good thing. Okay, so that's how we look at it. Okay, now the other thing we look at it is maybe got some risk amount and also stockholder equity, shareholder equity. This is a minus sign. Okay, what does that mean? That means we have been making a lot of losses. So the losses actually, luckily, is going down, but it's still a loss. We like to see a trend. Okay, in the future, there will be lesser losses. Okay, so if you're a bank, you're a little bit worried with this thing. Okay, now the other statement is called the income statement. It shows you how much sales you make and how much profit. Okay, it looks like this. Same company, HCL Healthcare. This is the actual company in US, no? I just extract out the figure they saw. This is the sales amount. So you pay for salary, supply, operating, depreciation, interest expense, gain or loss, whatever it is. Loss on retirement on that, what is the total is so much. Okay, this is the total expense. So this revenue minus this expense, we call this the income before income tax. Is it higher? No, it's getting better. No, getting better, then slightly off. Why is it slightly off? Revenue is increasing, but so is the other thing increasing. Supplies is increasing, or most of the line is increasing. So even though sales is increasing, your expenses also increasing. Your expenses is increasing more than the ratio increase. That's why your income has been from 5.3 has down to 5.2. Okay, so here you see a good increase, maybe 25%, and here you see a little bit down. We need to ask why. We need to investigate. Is it why so much? The increase in sales justify this increase? Okay, justify the supply increase, justify all other increases. Here they go and check one by one. Okay, so this is the income. Then you got provision for income tax, net income. Then maybe got some non-controlling interest. Maybe you put some money in the bank, okay, or you buy some shares, and that shares, other company share, they pay you dividend, or you put money in the fixed deposit account in the bank, those interest is coming in, it'll be up. So this is a net income. Okay, little bit down. Last year was a very happy year, but this year is little bit down. And this is the crucial part. This earning divided by the number of shares. Okay, number, not value of shares. Huh? So this is the total income divided by the number of shares will give you this ratio. This is the price earning ratio. What does that mean? If you have an earnings ratio of 10, this income is the yearly income. Okay, so this yearly income represents 10 ringgit. That means when you invest $1, okay, you will get, the company will earn $10. If you take the 3,505 divided by 10, that means you have to earn 350 years old. That's the problem. So why is it so high? Well, depending on industry, okay, people expect it to be very good, right? So it's not so good, so there's a problem. Okay. Now, does this equal to cash? Right? If you sell this one by cash, you pay everything by cash, therefore there's an increase in cash in the bank balance. But not necessarily you sell this all in cash. Sometimes you sell, but the customer haven't paid you yet. Understand? Or this is the supply, okay, or some salary, okay. You incur the salary, you buy some supply, but you have not paid the supplier, or you have not paid your people. So this is not your net extra increase in cash. It's just the income. So income and cash is different. You say you make a sales, good. And from that sales, you make a profit, good. Have you collected back the money yet? That's the key. If you have not collected the money yet, then it's still income, but your position is different. Okay? Your position is different. You say you make sales and you make profit, but you have not received the income yet. You haven't received the cash yet. So that's why we need to have one more thing called cash flow statement to see how much money the company still have to pay for the future. Okay? If you have a negative cash, you need to borrow money, right? To pay your suppliers or your employees, or else they will sue you for bankruptcy. So that's why we come to the cash flow statement. The next statement. Now, again, this is a cash flow statement. So cash flow from operating activities. So these are the first category, cash flow from investing and cash flow from financing. So we break the cash flow to three. The first one is the net income. Then minus all this increase in tax, changing of the balance sheet items. This year with last year will affect your cash flow. So, and then you may have buy something, land or building or whatever it is. So this is net cash provided by operating activities. Very important, must be a positive sign. Cash flow from investing, maybe you buy some property. So this is another figure. That's why it's a minus sign. Now, it's very dangerous when your use in investing is more than your cash received. Okay, it's dangerous. Okay, nobody will lend to you. And the cash flow from financing, maybe you issue some debt or you to pay back some debt, minus sign. So this was the beginning cash flow plus the net balance in the cash flow. Net balance cash flow come from all this net cash flow one minus 1771 plus 7602 minus 5702. Therefore, this will be the change, and this opening balance plus this one will be now your ending balance of the cash. You need to know this amount of figure so that you can do your payment. Now, I want to extend this. This is the year-end one. So what about next year? Many companies will do a cash forecast, sometimes week by week, sometimes month by month. Why? Because they forecast if got a certain month is a negative. Let's say, for example, this year, June, our cash forecast in this year, June, will be negative, whatever reason. So negative is bad. You cannot pay people. So now, March, you must go to the bank and make arrangement for the bank to lend you money for the month of July. If your cash, if I repeat, your cash forecast for July is a minus sign, what do you do? Now, you have to go to the bank and ask them to lend you money for July. Why don't you go and see the bank in July? Too late. Because the bank will be asking for a lot of documents and asking to study, and you are not the only fellow want to borrow from the bank. The bank every day face a lot of people wanting to borrow money. So therefore, the bank is very busy. So that's why you need to do a cash forecast for the next week or month, okay? Like this way of doing, okay? Like this way of doing. Ask your accounting people to do so they can see the cash forecast, which month is no good. So you need to borrow for short term. Now, if the cash forecast is a big amount and you're going to last for many, many months or many years, you don't go and borrow short term. You have to go and borrow long term, 5 years loan, 3 years loan, or you increase your share capital. Okay, so that's important, the cash flow. Now, again, I repeat, cash flow is to run your business. Negative cash flow, how are you going to run your business? Income statement is to show you make profit or loss. That's all. So income statement and the balance sheet is not cash flow. Okay. So balance sheet is to show your asset and your liability. And the income statement will show you your revenue, expenses, and the net will be either profit or loss. Cash flow will actually show you which month you're short or which month you have a lot. If this month you have a lot, then maybe you want to put temporarily park at the bank as a fixed deposit. Okay, because you have a lot of cash. No point to keep. Might as well you earn a little bit of interest, also never mind. Okay. So linkage, integrated. So your income from the income statement will go into your cash flow as one item in the cash flow to be considered. And also, sometimes you spend a lot of money for capital investment, big item, buy a land, buy a building, buy some cars, buy 100 laptop or whatever it is. So you need to know when to buy. If certain month is not enough money, you need to go and borrow. Or you maybe need to delay if you cannot get the bank loan. Okay, so let's say, for example, you want to buy a land and the land had to pay in July. And therefore, in the month of July, your cash flow is negative. You need right now to go to the bank and borrow money for the shortfall in July because you want to buy some land or something. Okay, so that's about it. Non-profit versus for profit reporting. Now, healthcare, you got public hospital and private hospital. Okay, now for profit one, it's very simple. If you are KPJ, for example, so you're a private hospital, you are thinking about profit. So it's important for you. Okay, for the income statement. Now, if you are a non-profit, let's say you are a government hospital, they are not so care about the loss because always not enough money they ask for the government. So the criteria for non-profit is company is not money. Maybe it's a satisfaction, maybe it's some sort of KPI, how many patients was treated and so forth. Okay. So for non-profit company, so where do you normally get your income from? If you're a government hospital, government give an allocation every year. But if you are KPJ or Columbia Hospital, you need to get profit. Okay, or else you cannot have asset. Okay. So revenue also same thing. If you are a public hospital, they don't care about their sales amount. Most of us go to government hospital maybe free, right? So they don't care. Okay, because they are government hospital. But if you are a private hospital, you very care. What is your revenue and sales? Because revenue and sales minus it becomes the net profit. Okay. Tax treatment. If you are in Malaysia, if you are a government hospital, you still need to file the income tax form 990. Okay, 990. If you are normal company, you still have file 10K. This you don't have to worry. This will be accounting people too. Okay, and also property tax if you are selling or buying property, real property, for example, land. Okay, there's implication because you need to pay real property gain tax if you are selling. Okay. So if you are for profit company, you're always thinking about revenue growth, earnings, income before interest and tax, and depreciation or amortization. That is the normal net income, okay, before bank interest, tax, or depreciation or amortization. For non-profit one, your annual report, you don't worry too much about your P&L. Okay, you just talk about care statistics, okay, and so forth. Charity care statistics. Anything else? Okay, ratio analysis. Now, why do we do ratio? We'll come back here. Ratio is calculated from where? Ratio is calculated from your balance sheet, asset, your balance sheet, liability, and shareholder, and also from your income statement. Now, why do we use ratio? Do you know what's ratio? Let's say, for example, 3505 divided by 5136, that's the percentage to sales. Understand? 23560 divided by 51336, that is the ratio of salaries. Now, why we look at ratio? Because you can see the amount, right? Wait, the amount going up, no problem. Net income also going up. But what's the ratio? If you just see a gross amount, you cannot see whether the company is okay, doing well or not doing well. Therefore, we use ratio. And once we have the ratio for each one of them is to sales for income statement. And for balance sheet, there are various type of ratios after we will show you. So we use ratio, this year ratio compared with last year ratio, or we use our ratio to compare with our competitor ratio. Now, how to get competitor ratio? Same. You go to the SSM and print your competitor balance sheet and P&L, profit and loss. Then you can compare ratio. Okay. For example, let's look at. I think you know Aeon. Aeon is very big, right? And let's say you look at the smaller one, maybe KK Mark. So how do you compare which is better? you look at ratios. To see the ratio will tell you which company is run more efficiently. Okay, but if you just compare Aeon amount with KK Mart amount, cannot compare lah, right? One is a very big player. So if you just compare amount by amount, you cannot tell which is the better company. But if you look at the ratio, let's say net income ratio, if you see the net income ratio, if this is 20% for you, and maybe Lotus is 15%, we are better in terms of ratio. That means it shows that your company is better run. Okay, so we now look at the ratios. There are many types of ratio. So liquidity ratio, this is the formula. So here got some remark, a figure below 1.5 significant difficulty meeting payroll and supplier obligation. If it's below 1.5. Days cash on hand is a formula. If you hold too much cash, why are you holding too much cash? The cash should be converted into bank deposit, right? Asset ratio, immediately we must pay people. Then you have leverage capital structure ratio, so many ratios, and on top, all the ratio got comments, so please look into it. Profitability ratio, activity efficiency ratio is all the formula there. Okay, this one is used for benchmarking and peer selection. Now, what is this ratio? Activity and efficiency. If I'm the bank, Aeon come and see me to borrow money, KK Mart come and see me borrow money. So I look at the ratios and I can compare peer selection, which company is doing better. Now, when you talk about supermarket ratio, compare with another type of business supermarket. You don't compare different industry because different industry is different. Let's say, for example, supermarket industry. Supermarket industry, a lot of cash business. Let's say compare with another company who's making equipment. Equipment sales is always on credit. So we are not comparing same is same. Please compare within the same industry, you and your competitor, and compare you and your previous you. Then you can see the trend and you can make decision why this is no good. Like for example, this is the income statement. If our salary to here, right, is 22%, and if here is 25%, that means we are better. What about this percentage here compared with your competitor? Then you will know finally which area you need to improve, because ratios that are showing worse than last year or worse than your competitor, you need to improve on that particular item. Understand? You know, how do you know which area to tackle? Okay, you have P&L, everybody happy? Oh, we are a little bit down, everybody happy. That means you cannot improve. So for the company to make more and more money, they have to compare their ratio with the competitor or compare with last year, so they know which area they are slacking, so that they can identify which area need to have some other solution. Okay, that's one of the main purpose of ratio. So there are many type of ratios: profitability, efficiency ratio, benchmarking. So what's the limitation? Ratio is talking about the past, because the accounting documentation is reporting what happened in the past. It does not signify what will happen in the future. So when you're doing ratios to do decision making, please remember your ratio, is it the past historical ratio or a forecast future ratio? Okay, and many cases, we have subject like a quantitative method to teach you how to do forecasting for your future. Okay, Because if you a bit biased and you forecast very good in the future, then of course your ratio is going to be very good. So no action taken, right? Okay, here, financial performance indicator. Look at the ratio. It will help you to know which ratio is having problem. Okay, which ratio having problem. So you can say maybe you're good in supplies, but you're very bad in salary. You know, so you need to go and check what's going on. So there are some trend here. If your current ratio below 1.3 is a problem, this is total, not asset, total cash itself. Okay. And if you have negative operating margin, okay, net profit before income tax and interest, if you have 2 years, this company in problem. Okay, 2 years is 24 months. Now, some company may be in the minus for many years. Okay, I think one good example is Amazon. So before Amazon now becomes so strong, in the earlier years, they are all lost. But they never go bankrupt because all the investor comes in. Why the investor come in? Because the investor think Google is a good place to park my money. Because if I park my money in the bank, I get very low interest. Might as well I park my money in buying shares. Okay, so there's a few company that is very good for earnings per share. These are company that you need to buy. And if your ratio is very bad, below 1.3, it's going to be worrisome. So therefore, it's going to be early warning signal, okay, for you to take action to correct the situation or to go and borrow money, okay, one way or the other. So bond rating. Now, if your company is public listed, or if your company got shares in the stock market, or your company got bonds, bonds means company IOU, okay, company IOU certificate. You give the money to the bank, the company give a certificate. It says that, oh, the bank, the company owe you certain amount. I mean, within 1 year, we will pay you back or whatever it is. Okay, so these are all called bonds. Now, there are outside people, they are doing bond rating. Okay, basically, American company, they are doing bond rating. Now, why this is important? Because as an investor, sometimes you want to look at the rating by the outside people, whether this company is good. Only problem, if the bond fellow also are biased, okay, then we got problem. So now you have also got non-financial stakeholders, physician communication, community advocates, okay, pay money to a company, broadening or understanding, okay, with trend arrow or whatever it is, so people can understand your presentation, okay. So you need to communicate non-financial information also. Okay, then anything else? Nothing. Okay. So this PowerPoint is based on the subject. So let's look at the subject. Okay. Healthcare financial statement analysis. Okay. So the 3 documents, the balance sheet, the income statement, and the cash flow. Okay, these 3 documents will be important for you to look at the trend. And also you can use this trend to forecast for the future. Okay. So far, any question? Shama?
Don't have.
Okay, now we come to communication, two-way discussion. Okay, I will simply call name. Okay, Kalai Manan. Kalai Manan, are you there?
Yes, sir.
Tell me, why is it important to do your cash forecast?
So that we will know whether we are every year we have improved the revenues or not. Basically, it will shows our growth in our business basically.
Either you put your mic too near to your mouth or it should be a little bit further away because I cannot hear you clearly.
I mean, basically, it will help us to know our company's revenue, whether we are doing a good job or not. That means every year we are doing better or not by having
No.
the cash.
This answer is only partly correct. You do cash flow forecast to know when your company don't have enough cash, so you need to borrow money. Or when the company have got so much cash in the future, so then you cater to put the money into temporarily fixed deposit. That is the purpose of cash flow. To know when you don't have enough money, so you need to borrow now. You understand? Okay. Now, Jaswan Zailani. Jaswan, you're not there? Subhashini? Subha?
Yes, sir.
Okay. Why is it important to look at the income statement? Subha?
Can I guess, sir?
Can.
I think it's important so that we can compare our income and we can calculate on our profit and loss, or to track on the revenue and our expenses. So with that, we are able to get our gross profit. I think so.
And also, if you compare it with the competitor or in the past, you can see how well you're doing against your competitor or how
Performance.
worse your competitor. And if you're comparing against your own self, the trend for the past few years, are you getting better or are you getting worse in the items? Okay.
Yes, that's right. Thank you, sir.
Okay. So now we'll go to the next one. Okay. Chapter 5, cost accounting. So we'll look at types of healthcare, cost behavior, and measuring service line profitability. First, we want to talk about cost. First, I want to explain to you what is variable cost. Variable cost means you start with zero, no activity. Okay? So if you got more patient, maybe your gloves will be using more. Maybe your needles will be using more. That's what it means by variable cost. These are the costs that varies with the level of activity. If at this level of activity, this should be the cost. At this level of activity, there will be more cost. More people coming in. Details are hidden while you share your screen. I don't know. Oh, class monitor, can you see the screen?
Yes, doctor.
Okay, so basically this is called variable cost. So if you do nothing, no patient, no need to use gloves, no need to use needles. But if you got X amount of patient, then you will have Y amount of cost. Okay, so same like production. So if you want to make 1 million mineral water, you must have 1 million bottle cap, 1 million plastic container, right? So these are called variable costs. Unless there are some changes, most variable costs will start with zero and go straight. Okay. So in medical supplies, fluctuate with patient volume, bandages, needles, diagnostic material. These are variable costs. Now you may also have agency staff, temporary nurses, technician, locums, temporary locums. Okay, so they come to work, you pay. They don't come to work, you don't pay, right? So this is variable cost. Okay, medicine. Okay, also more patient, more medicine. Less patient, less medicine. Okay, Now, this is important to know because if you forecast now you're having 1 million patients, but in the future you will have 2 million patients. If you increase 100%, therefore your expenses also must forecast increase 100% for the variable cost. You understand? So if you forecast 100% increase, your variable cost also should be forecasting 100% increase. Okay. So therefore, when you forecast, then that's why we're talking about cash flow, isn't it? Right? You will forecast extra money coming in. You also forecast extra money going out to buy syringe, bandage, or whatever it is. Okay. Now, what is fixed cost? Fixed cost, the cost is the same. Don't care your activity. Okay. If your hospital is renting, okay, is renting a very expensive MRI machine, or your hospital is renting a very expensive building, whether you got patient or no patient, you still pay the monthly rental fee. That is called fixed cost. So in your cash forecast, if you are paying rental, so there's the same amount every month. Now, here comes the practical. Now, as far as variable cost is concerned, we are not so worried. We have more patients, we collect more money, and then we, of course, have to spend more on bandage or syringe or needles, right? So it's not so bad. Okay, when volume go down, we spend lesser. But fixed cost is different. Zero patient come, your rental is the same. You're working 3 shifts, the rental is the same. You're working only 1 shift, office hour, the rental is the same. What does that mean? For practical, control your fixed cost, because you do not know when the activity can be very low or the activity very high. So many people will look at how to reduce costs. They will reduce costs first from the fixed cost side. Okay, so your contract should not be signed for many, many years. Because if you sign your contract for many, many years and you cannot have the activity level, you have to bear the fixed cost. Okay, whether you make a profit, you make a loss, the fixed cost is always there. Now, here comes the problem. Renting is easy. What about salary? Now, most salary, monthly payment, fixed cost. Whether you're 28 days working or 31 days working, same amount. Whether got patient or no patient, right? The ambulance driver is still the same cost per month. So we try to reduce fixed cost. So that means what? The more the activity, since this amount is the same, if the amount of activity become more and more, the fixed cost per activity, of course, will go down. What about variable cost? Variable cost is different. The more activity, the higher the cost. But the cost per unit, variable fixed cost per unit is the same. Okay? Fixed cost per unit is different. We will now use the example of why cannot go to sheet 2 one? Something wrong. Oh, okay. Okay. So let's say, for example, this is your fixed cost. Every month you must pay 100. Okay. And this is your variable cost. This is $1 per patient. Okay. Now, let's say now your number of patient can you see, is it very small?
Can.
I make it bigger for you. Hang on. So this is the rental cost. This is the fixed cost, the rental cost. Maybe this one is the bandage cost, okay, or needle cost. So let's say the number of patient is 1,000, one case, and you have another case 2,000. Okay. So what do you pay? Fixed cost still the same. What about variable cost is $1? 2,000. Right? 1 times 1,000, 1 times 2,000. Okay? So what's the total cost then? 1100, 2100. So cost per patient plus this divided by the number of patient. 1.1, 1.05. It becomes lesser. Why? Because this can be break down. This cost per patient, I will say this is hang on. As per normal. So this can be considered as total cost. So what is the fixed cost per patient? And what is the variable cost per patient? So what's the first curve per patient plus your fixed cost divided by what about the variable cost divided by number of patient, right? That's why the total is 1.1. Let's look at this side here. See, the variable cost doesn't change because more patient, more patient, more money. Okay, more patient, more money. Therefore, the variable cost never change, but the fixed cost will change. The more patient, the lower the fixed cost. The less patient, the higher the fixed cost. Okay, now what does that mean? That means fixed cost is fixed cost. We better generate more activity so that this can be reduced, and therefore our cost is different. So now, if you say sales price per patient, right? And you want to have a plus 20% markup, Understand? So what will be this cost? So this will be times 1.2. All right? And this will be, notice now, the more patient, you can charge lesser because the fixed cost is going down. You understand? That's why many companies want to have increase in sales, increase in customer. Okay? Increase in customer. So far? Understand? Class monitor. Understand?
Yes, doctor.
Okay. Where am I now? Okay. So that's what I mean by fixed cost and variable cost. Okay. So the rest you can read. So now let's look at the picture now. This is units or patient. Fixed cost is a fixed unit. So variable cost, why don't you start here? Can't. But what's the total cost? The total cost is the variable cost here. This line here is actually the variable cost line. You understand? So the variable cost line at the fixed cost is the total cost line. Okay? So this portion here is fixed cost amount. This portion here is the variable cost amount. The more the units, the more the variable cost. That's why this is the total cost. That's how they draw. Okay? So where is your sales? So if your sales is somewhere here, this is a break-even point. We will explain that one later. Hang on. The semi-cost, if we go by range, maybe you buy needle. So if you buy 1 to 2,000, this is the price. But if you buy more, sometimes you have to pay more. Sometimes you pay less. Okay, therefore you call semi-fixed variable. Sometimes go up, sometimes go down. Okay. A good example is like, for example, you have right now renting the KPJ you're renting. Okay, inshallah. Now you want to expand. You want to expand, so you want to rent another piece of land beside it. It's not the same rental per square feet because it's a different landlord. Okay, so sometimes that is called ranges. Okay. Now, what I mean by opportunity cost, something we can. Opportunity cost means if they spend money on certain thing, on A, that means, let's say you spend $10 on A activity. That means that $10 cannot be used for B activity. For example, if you spend money to make a lab, blood test lab, that money cannot be used to buy an MRI equipment, right? So before you spend money, you must think. Better to buy on lab or to buy an MRI equipment. It's simple as that. So that's what it's called opportunity cost. That means you don't simply spend. You must know what you're going to spend. Right? Very simple. If you got $100, you go for an expensive dinner, $100, or with $100, you can spend $20 in cinema, $20 in gin, $20 in chapati store instead of $100 on the fine dining. So the fine dining $100 opportunity is represented by your jeans, your chapati, your cinema cost. Okay, so you look at this from the mind of thinking, which is the best way for you to spend the money? Opportunity cost. Now, sunk cost means you buy equipment already. That's it. You pay already. All future decision, you cannot recover back the money. So because of that kind of thinking, when you look at, should I buy a replacement machine or should I not buy a replacement machine? The original equipment that you pay for should not enter into your consideration. Okay, that's what I mean by sunk cost, because it's already gone already, sunk already. Money you spend in the past, you cannot recover back. Okay, opportunity cost is different. is entirely different from sunk cost. Opportunity cost is, if I don't spend here, I can spend another place in the future. Okay? Sunk cost, you already spend already, you cannot do anything. Okay? Controllable versus non-controllable. Now, some costs you cannot control. If you are a doctor, you have to pay for, how do you call that one? The license, medical license. As a hospital, you have to. Can you hear me? Class monitor?
Yes, yes, I can.
Okay, just now the line was down. Okay. So now we reconnect again the line. Okay, where are we? Okay, so there are some costs that's controllable, please control, but there are some costs that's non-controllable. So another way to say is this is variable cost, this is fixed cost. So, well, it's not controllable, but it's not controllable only in the short term. In the long term, you can do something about it, even though it's fixed cost. Like, for example, a renter. A renter is a fixed cost. But maybe after the contract over, we go for another contract again, renew, renegotiate, or if it's a rental for a building, you go to a new building. Okay, so even though it's fixed or non-controllable, it's always short term. It's not going to be for the next 20, 30 years. Okay,
Sorry, doctor.
so
We cannot see the slides.
hang on, because just now the line is down, but you can hear my voice,
Yes, can.
Okay, just wait. That's why we need to have a class monitor. Shaima, correct?
Yes, doctor.
Okay, you become class monitor, I give you extra mark. Don't worry.
Thank you.
Now can see,
Yes, now I can see.
So controllable, non-controllable, anything else? Average marginal cost. Average cost, I think you know, no big deal, all of you. Marginal cost is the cost of making extra 1 unit. Okay, so that's a relationship. Okay, this is the volume of output. This is the average cost. Now, sir, how come the average cost could be going down when there's a quantity, isn't it? Correct. Then why does the average cost goes up? Sometimes it goes up, or sometimes you keep on going down. But there are cases whereby average cost can also go up. Yes. Okay. So this example, maybe your fixed cost, suddenly the rental increase, or your variable cost, instead of $1 item, supplier now want to increase the price of needles, so the average cost can go up. Okay. Now, what do you mean by marginal cost? Marginal cost is the cost of making one extra output. Now, when here and here cut each other, we call this the equilibrium. Okay. Now, what's wrong with this one? This is a good chart in theory. Actually, your cost keep on changing. Okay, at least once a year, your cost will change. Why? Your people salary increase. Sometimes supplier increase price, sometimes supplier reduce price. Okay, and therefore will be affected both. So this equilibrium position is only as of now. Okay. Okay. Now we come to another one, cost behavior. Not so important, this one. I will jump. Okay, this one may be important. This is year. This is the income, total product sales, number of products sold. So the price, you never change the price, is fixed. Variable cost sometimes go down because you find a cheaper supplier or you introduce more machine. So your variable cost go down. This nothing to do with fixed cost. This minus this is for the contribution margin, and the ratio will be against the sales amount. Okay, 64. Okay. Somebody send me a message, you guys. Shimran here. Oh. Okay. So now you will look at this ratio, and we will introduce to you a break-even chart. Fixed cost divided by contribution. See, selling price per unit minus variable cost. What is this? This is actually selling price per unit minus variable cost per unit. So this is the contribution margin. Okay, it can go up, it can go down, doesn't matter. So what is the break-even point? Fixed cost divided by contribution. Why this is important? This is the point of sales that you must achieve. Once you achieve this one, no gain, no loss. If you sell less than this one, you make loss. If you sell more than this point, you make profit. Okay? This is what it means. Again, we'll have the fixed cost here. Now, this orange color actually can start from here one. But to see the total cost, we put the orange color on top of the red color. So this is the total cost. And this is the revenue. And when the revenue it touch the total cost, this is the break even. What does that mean? At this point, your total cost is here. Your total revenue is also here. Means you no make profit, you no make loss. And therefore, if you are selling less than this quantity, let's say you're selling here. Okay, you're selling here. Okay, what happened? You're selling here. Your cost is here, orange, and your blue color is the revenue. So this is the loss. Let's say now you're selling here. If you're selling here, this is your sales in dollars, and this is your cost in dollars. So if you're selling here, this triangle is your profit. Now, why is this taught? This is taught to you so that you can understand. You can tell your marketing people, hey, you need to minimum sell 10,000 per month. Therefore, the company no make money, no make loss, which is not so good, but better than loss. You should actually now try to sell above 10,000 to 8,000 to 8,000. And that's where they tell the marketing people, if you sell more, we give you commission. If you sell less, no commission. Understand? So that's what it means, a break-even point. This is in theory. In practice, you got a problem. Why? Let's look at this. You assume only one product and one cost structure. Year by year, of course, the cost structure will change. No, the variable cost won't change unless very much drastic. The point is, you don't sell one product. Every company doesn't sell one product. Even you mobile or even Maxis, they can have data plan, they got voice plan, right? They got a company plan. Nobody sell one product. Can you imagine 7-Eleven only selling one product, right? Or Nestle selling only one product? Nobody sell one product. Why? Because it's dangerous. If you sell one product and the product doesn't sell, how you go bankrupt straight away, right? And then many people want different sizes one. Okay, if I sell drinks, okay, large bottle, small bottle, panas or Sergio or what bag, right? All are different prices. So your marginal profit will be an average, because if this is a few product, this will be an average. And because it's an average, here comes the chart. This one will be an average of a few product. So you got to ask the salespeople, hey, you sell about this figure, but it's going to be an average. So sometimes you sell one product more, you sell one product less, will have an impact on this revenue line. In other words, break even is not applicable. In theory, it's good. In practical, no. Okay? In practical, no. Okay? So anyway, managers has been outside using this the CV cost volume profit. Use this formula. So this is we can see some example here. Target volume, fixed cost, selling price 150, variable cost, contribution for margin 30 cents. Now, if you want to have a target profit for some amount, this is your fixed cost plus this amount divided by 360, you must sell 64800 unit. You understand? But that's a problem. This unit is a combination of various sizes, various type of products. Big problem. Okay? So in theory, it doesn't work like that. Okay? Now, sir, if what you say is true, what should we do? Okay? What should we do? Okay, let me see. Class monitor, where are you?
Yes, doctor.
You know how to cook?
To what?
You know how to cook or not?
Cook?
Yeah,
No.
cooking.
No.
You're no good for cooking.
No.
Then how are you going to get married?
I don't know.
Okay, never mind. I say, okay, you say you know how to cook chapati, ah? Okay?
Okay.
Okay. Now, the cost of making a chapati, let's say $1. Okay? Now, you want to have a profit, certain amount to invest. It is the gain from your sweat. Let's say it's 20%. So, you want to sell how much? One chapati. Understand?
Yes.
Class monitor, understand?
Yes, doctor.
Your cost of making a chapati is $1. Your profit is 20%. Therefore, your sales must be 120. Correct?
Correct.
You're a shy man. Okay. Just one, are you there? Just one. Yeah.
Yes,
You're not
yes.
there?
Yes, I'm here.
You're here, huh? You hear what I say about Shaima, the class monitor, making the chapati?
Yes.
Yes.
Now you, this guy, he wants to buy chapati. Understand? So when you go to the shop, Shaiman's shop, does he care about these two figures? Do you care? Boy. Shasman, do you care about this figure?
No.
Shasman, what do you care? You only care about this figure, isn't it?
Yes. Yes, Mr.
So you would think, so this is, what's your name already?
Shazwan.
Class monitor name is called Shaiman.
Shaima.
No
How to
N.
spell?
No N at the end.
Oh, Shaman. Yeah?
Shaima.
How to spell?
S-H-A.
S-H-A.
S-H-A-I-M-A.
I-M-A. Okay. You are Shaima, the seller. Correct?
Yes, doctor.
And who's the buyer now? Hey, this one I point the
Shazwan.
buyer. What's her name?
Shazwan.
How to spell?
Shazwan. S-H-A-Z-W-A-N.
S
S-H-A-Z-W-A-N.
H A W.
A-N.
Okay. You are the buyer. Correct? Do you care about this figure? You only care about this figure. Right? You only care about this figure. And whether this figure, we call this the value perception. If you think 120 is okay, you buy. Understand? If you think 120 is too expensive, you don't buy. If you think 120 is cheap, you buy two. That is called value perception. You understand? So what now Shaman must do? What Shaman must do? Shaman actually must do a market research. In market research, Shaman must go and find out what? What must Shaman find out? Where go to the wording?
Price
Don't know,
in
go
other
where.
place.
What must Shaman find out?
Must found out other seller how much they are selling at the price. They need to compare.
Yes. Understand? Eh? Why am I having so much problem one? Okay? So she has to go and find what is the sales price. And there are many chances. The sales price can be $1. It can be 130. Okay? You don't know. He has to go and find the price. How do you find the price? How does Shaima find the price? Do your own market research. Go and check your competitor. Check the surrounding people. Check you are making chapati, isn't it? You check because sometimes people want to eat thosai, want to eat chanai. So thosai and chanai, are they selling? You go and do the market research by yourself, or you appoint a market research group company to do it, to find the sales. Understand? So now what happened? If after market research, they found that it is $1. And therefore, if you still want to have profit, listen carefully to me. If you still want to have profit 20 cents, this should be your cost. What should be your cost? is 80 cents. And you, Shama, right? You, Shama,
Yes.
your activity is now your one is $1. Your activity is to try to bring it down to the cost of 80 cents. Why? Because Shazwan only want to pay $1. That's all. So how do you find the sales price? It's not from cost minus profit. Add profit is your sales price. Now, if you cannot get this target cost, you have to work harder. It takes you time. But in the meantime, you can have only zero profit because your cost will tie back to your current cost. So the activity is for you to, if you want to maintain at 1, then it will be 0.9. So you can only achieve 0.9, therefore your profit might not be 0.2, must be 0.1. Because this fella, he don't care about his, he only care about the value perception, whether he wants to pay $1 is fair or 130 is fair. Now, the problem is, Shazwan only thinking like that. You may have Mr. A, Mr. B, Mr. C, Mr. D, so many people all got different thinking about value perception. So when you're doing market research, depending on which type of customer, are you going for the rich, average, or poor customer? And if it's a rich customer, what's the average for a rich customer? What is the average for the middle class customer? What is the average for the poor customer? That is the price that is the value perception. Understand? Understand or not?
Understand, doctor.
That's
Yes.
why Mama Store is selling roti canai 150. You go to an Indian restaurant, the fellow is selling roti canai 2 ringgit, 3 ringgit, because they are dealing with different type of customer. And because of different type of customers, so let's say, for example, this fellow is selling, Shaima want to sell to cheap one. What happens if Shaima want to sell to rich customer? Now, if Shaima want to sell to rich customer, he have a choice. He can put 0.2, and then he can have a target cost 1.1. Then his can be a better ingredient, okay, than his cost right now because he's selling more expensive, or he will have still 0.3 and still having same cost. So this is fluctuating. This is your activity. This cannot change. Oh, sorry, no way. This one is market control, judgment control. Sorry. These two you can control. Having said that, don't care what product you're selling. It's nothing to do with fixed cost, nothing to do with variable cost. They don't care. Does Shazam care? And if Shazam does not care about variable cost and fixed cost, he's only worried about this perception value, which is this price. So why are you talking about cost for what? The only thing you talk about cost is to see what is your actual cost and what is your target cost. You are going to move. Your activity is to move your actual cost, right now cost, to the target cost. That's all. And if you cannot do that, let's say for example, you cannot do that. Okay? Because still keep $1. So it's zero. No profit. You work for your own business. But you don't do. Right? That's the key. So forget about what is tissue in theory. Many people do like this. Why? Because Shaima only know how to make chapati. So she thinks that's what I can do. The market may not accept your chapati. And if they accept, they do not accept 1.2. It's all value perception. Company go bankrupt because of this. So now Shama want to sell at 1.2. Shazam want to buy at 1. So what happened? Cannot sell. So Shazma go and hire a marketing manager. Marketing manager try to push as 120. But Shazma still want to buy at $1. Still cannot sell. So Shama sack the marketing manager, bring in a new marketing manager. Same thing again. Oh, then suddenly, oh, why don't you buy one, get one free? No, that kind of strange thing coming out. Why do you give discount? Why does company give discount? Because they are not selling. If they are selling, they don't give discount. Why are they not selling? Because your sales price is different from the customer value perception. Try to find all the products that you have in your company. What is the value perception for the buyer? Which buyer? You have 1 million buyers. See, are you dealing with niche market, rich customer? Your business is for rich customer, your customer is for poor customer, your customer is for average customer. The average price of the various type of market. That is the value perception price that decide in market research. Is that understood?
Yes,
So
doctor.
I'm teaching you
Yes, sir.
something that's outside your syllabus because I'm sorry, the syllabus is only in theory. Okay. So the rest you can read yourself is not so important. Okay, now come the question. I will call people already. Okay. Where am I now? Ui? Okay. Who have not called? Your name in front of all must call. Subhashini, where are you? Hello. Subhashini. Subha. Yeah.
Yes, sir. We are two person with the same name. I'm Shubhashini Gondras.
Oh, yeah. You got Subhashini. Hey, your sister.
No, sir. No.
Okay, okay. I will call you SG and the other one is called ST. Okay?
Yes, yes, sir.
Okay, SG. First question. Okay? First question is, let me think first. Where is it? Here. Why this one do not work? Hello, are you there? SG? Ui? Monitor, say something. Line down only.
Yes, sir.
So how? SG? Not ST, SG? Why this one does not work? What's wrong with this one? You don't know? Okay, another person try. ST. Another
Sorry, sir.
Subhashini.
Sorry, sir. I
Okay,
don't
why?
understand.
Huh?
Sorry, sir. I don't understand.
Why this not make sense? Why this graph does not make sense? You don't know. Shazwan? Where are you?
Yes, yes, sir.
Why this chart doesn't make sense?
Mm, I'm not sure. Maybe because it's like too simple to, because it maybe multifactorial to know actually.
Yes, it's too simple. In the business world, things are complicating. You don't sell one type of item, you sell various type of item. So your revenue is not a straight line because there's a mixture. So sometimes you sell more mineral water, sometimes you sell lesser carrot juice. Next month, you sell more carrot juice and you sell lesser mineral water. Therefore, the revenue is not straight because you sell many products. Fixed cost maybe is correct, but variable cost is different. This month, very low variable cost. Why? We sell water, plain water, cheap. We sell very little carrot juice, which is expensive. Therefore, the variable cost line is low. Next month, you sell more carrot juice and you sell lesser plain water. Of course, this line will be different. The mix of products cause the revenue line and this total cost line not so easy as a straight line. It's only easy for a straight line if it's only one product. But because you are selling different product, can you imagine selling water and also selling carrot juice? They are different thing, you know. Maybe one cost $1, carrot juice cost, I don't know, 4 ringgit, right? So that's why this doesn't work. And telling people, okay, this is the point for you to minimum sales also do not work. What works? What works is very simple. Understand the value perception and the customer will come. Of course, you need to advertise lah. But when Shazam saw the correct value, he will buy. When Shazam saw the wrong price, he will not buy. Okay? So nothing to do with the cost. Nothing to do with your profit. Okay? As far as Shazam is concerned, he doesn't care. It's same as you, Shaima. Shaima, when you go to the supermarket to buy things, do you care about the seller cost profit? You only care about the price and the quality. In other words, you only care about value perception. So why is the seller having the sales price formula based on something, cost and profit, whereby the buyer don't care? If the buyer don't care about this thing, then why are you having the sales price controlled by these two things? That is the issue. Understand? So far, I understand everybody?
Yes.
Yes.
Yes, sir.
Okay. Now, in my class, I always teach practical. If the theory is wrong or ridiculous, I'm not going to teach. If I teach also, I will tell you why it is wrong. And most likely, I will not have an exam question because theory and practical is different. Okay?
Okay, doctor.
Oh, I'm that kind of funny teacher, okay? Now, we look at the next one, budgeting. What do we take 10 minutes break? Is it okay with you guys?
Yes, doctor.
Yes, sir.
Okay, now
Yes,
it's
sir.
4:40.
Doctor.
Wow. When I ask you to take 10 minute break, everybody say yes, sir, yes, sir. When I ask you question, everybody quiet. Huh? Oh, very funny. Huh? Okay, now it's 4:40, 10 minutes. Okay, 4:50. Okay.
Thank you, doctor.
Okay, welcome back. Class monitor, can you hear what I say?
Yes, doctor.
Okay, one thing before we proceed, right? And that is, I want to inform to you, healthcare. You guys are doing MBA in healthcare. You most likely are not doctors, right? You will be administrator or manager or something like that in the healthcare industry. Now, the most expensive private hospital, maybe Sunway Medical Center. The cheapest one maybe is Asunta, in PJ Newtown, and Sunway Medical one is of course, in Sunway. So they are catering for different type of people. Sunway may be the expensive people, rich people. Asunta one may be the middle one. The cheap one all go to public hospital. Okay, that one different. Okay, so when you compare Asunta and you compare with Sunway, they already do their market research. Let's say, for example, a blood test. Blood test in Sunway will be more expensive than the blood test in Asunta, because it's all a matter of value perception. The average people will go to Asunta. It's cheaper. Okay, the rich people will go to Sunway because it's more expensive. So the key is value perception for price and minus whatever is your profit that you want. That is your target cost. If your actual cost right now is higher than your target cost, you have something to do. Okay, to reduce the cost, you must do something. That's all. That's what I'm trying to tell you. It can be any procedures. So you can have a lot of procedures, a lot of things. Maybe you got knee surgery lah, throat surgery lah, lab test lah, MRI lah, medical fitness test lah, or whatever. Okay, medical procedures. All these procedures individually, Sunway must do their market research for each of their medical procedure for their type of customer. Nothing to do with cost at profit equals to sales. If you do like that, means if your cost right now is very high and you want to maintain the same percentage of profit or amount of profit, of course your sales price is going to be very high, and of course you are not going to get business. Okay, but your actual cost, what you need to do is your actual cost, you need to do something to break down to your target cost. Target cost is value perception of sales price minus the profit that you want. That is the target cost. Okay, so far clear? So nothing to do with the break even, how much you must make, because every procedure, whether it's blood test, knee surgery, MRI, normal doctor, specialist, every of these, you need to know what is the value perception for this different type of medical procedure for your type of customers. Okay, so anyway, let's continue. We will look now at budgeting and financial planning. Class monitor, can you see?
Yes, doctor.
Okay, why do we need to do budget? Okay, now think carefully. I think most of you may be working, so you know what's a budget. Somebody set a budget, somebody asks you to make a budget, and that will be the budget for the year. It actually is more complicated than by that. The correct way to set budget is start with the long-term goals and objectives. Now, who decide these long-term goals and objectives? Even before you come to here, do your budgeting and then develop your projection, allocate your resource, then you monitor your progress. Okay, this allocate resource is the budgeting here. Okay, even come to here, the long-term goals and objectives. How do you make the long-term goals and objectives? Well, let's go to here. To here. This is practical again. Who make the long-term goals and objectives? Maybe your CEO wake up in the morning. Your CEO, I am a Sunway CEO. And I will say, okay, we will increase sales by 10%. Why? Maybe his competitor is making profit 10%. His wife asked him to do it, or he feel like doing it because he's the CEO. That is a wrong way to make objectives. The correct way to make objective is to understand your external environment, which compose of the opportunity and the threats in the market for your industry. And you need to know your internal strength and your weakness in your company. That's why we call this internal and external. Only if you can understand. Let's say, for example, you have a hospital. What's the opportunity in Malaysia? Oh, a lot of old people coming. Old people don't die. So, means what? They will have need for medical care for the old people. Understand? So, there's a good opportunity. Maybe you got a weakness. You don't have enough nursing. You don't have enough nurse. All the nurses graduate from Malaysia or go overseas and work higher pay. So that is your weakness. So can you take advantage of this opportunity to take care of old people when you don't have enough nursing? So the CEO must understand what are the few important opportunities and what are the few important threats to the industry. Maybe the threat is like, for example, more and more private hospitals is coming out. It will be a threat. Okay? Maybe you have a lot of strength. You have a lot of doctors, experienced doctor, but maybe you got weakness. Not enough MRI equipment, not enough nurses. You need to understand this and try to take your strength, use your strength to use your strength to take advantage of the opportunity. Oh, terrible color. That is how you make your corporate plan. Not wake up in the morning, I have a dream, increase sales 10%. If you have too much threat and too much weakness, maybe you should get out from the industry. Okay? Or you got a few opportunity, a few threat, a little bit of strength. What should be the best way for you? So you need to analyze your industry. You need to analyze where you are. Okay? There are some opportunity you cannot take care of. Maybe there are a lot of old people. But this opportunity, because you got lousy weakness, you don't have enough nurses. Right? So you cannot take care of this. You cannot use this opportunity. So maybe you have to consider other opportunity whereby you have strength to take care of. That's where you come your corporate. Now, after you have done this, then you consider your mission and vision. Not mission, vision come first. It is the external and internal understanding. Then only you look at your mission and vision. Let's say, for example, if you're in Indonesia, you got very little opportunity, very little old people. A lot of them are all threats. All young people in Indonesia, they don't sick. Young people don't get sick easily, right? So even though you got strength and weakness, it's not important because the threat is too terrible. Or maybe there are a lot of new hospital coming out. Maybe you want to get out from the hospital industry because you cannot face the competition. After you have decided what, so let's say, for example, you decided, okay, we normally take strength of antibodies. So, okay, we have got old people and we have got a lot of doctors. So, what do we have? So, we have doctors as an internal, and maybe we have a growing old population. And therefore, if this is opportunity, and if this is the no, sorry. If the strength is your company have a lot of experience, doctor, and the possibility is Malaysia now got a lot of old people, so this is what you should be advantage. So from this, your understanding what is your goal. What should you do? So your goal should be equal to okay, seeing you got doctor, you're going old population, you better advertise in old people magazine or something, okay? Special discount for old people. That will be your goal for this year. Then that is a company goal. So now you got a various department. You got a finance department. You got a marketing department. Right? You don't know so many departments, okay? Okay, so now you got the HR department in your hospital. Okay, then maybe you have the medical department, you have the pharmacy department. Now, each one of them supposed to make their own goals. So if I'm the finance department, then our goal is to advertise the own paper magazine and get special discount. We now have to do the cash flow in case money coming is lesser, we have to go and borrow more money. Right? What about marketing people? Maybe they need to advertise in old papers magazine. Okay. HR department, maybe we need to. Okay. We have got some weakness here. Okay. We're taking care of old people. Hey, maybe we got to better hire more nurses, medical or pharmacy. We better stock up in the old people medicine. Maybe high blood pressure or diabetic, right? Alzheimer, okay, that's all medicine. So every department must make their goal that take advantage of these goals. And because they make their own individual goal for this goal, the budget must follow individual department goals. Maybe one goal, maybe two goal, maybe three goal for each department that achieve this goal. That's the best way to make a budget. If you don't have any goal, anybody can make whatever budget based on their thinking. So it's like a steering. There's no steering wheel. This is the steering wheel for the company. If there's no steering wheel, individual people go different ways. Okay, the engine go one way, the gear go one way, the wheel go one way, the car cannot go anywhere. Understand? So you must make this correct goal. Now, what happens if this goal was made correct wrongly? Because you do not understand this one. If you do not understand this one, so this goal was made wrongly, and of course, individual department, even though they follow the goal, but the goal was wrong, your company also in problem. So where does budgeting start? Budgeting actually start from understanding the market and understanding your company. Now, who can understand the market and the anybody can understand the market? Open your eyes. Go and see YouTube, see TV, go to conference, do whatever it is to understand what is in the market. Who will understand what is in the internet? If you are working in finance department, please get involved in pharmacy department. So we are looking for general managers who can understand the internet. If you are not familiar or you only familiar with one department, you are a manager, the finance manager, 20 years experience, nothing. It's actually 1 year experience, you work over 20 years time. Keep on repeating 20 times. That is 1 year experience, not working 20 years experience. You understand? So if you're a finance manager, you should understand what the hell is going on in pharmacy. Then you will understand the internal strength and weaknesses. Then the two, if 2%, better is 1%. If it's 2%, then 2%. If it's 3%, 3%, they all get together to identify what is supposed to be the goal and let the goal be accepted by management. No, sometimes you know what we do or not. Sometimes I will ask my management, hey, you tell me what is all this instead of I telling. You know why? Because sometimes management got a different thinking. And you can get a buy-in from management about the corporate because they are the ones who make this. So once you ask those people to make this, the senior people, the directors or the CEO, once you ask them to make this, then it's easy for them. It's easy for you to convince them what should be the goal. And once it's accepted, hey, individual, manager, come, various department, this is our goal. Please make your plan based on these goals. And your plan, what is the budget you need for it? Is that understood? What you see is sometimes there's this done wrongly. Why? Because this was done wrongly. Or they don't even know. So because they don't even know or not enough skill, so this was done wrongly. And so all these people are chasing after the wrong goal. So we need everybody to know the correct goal and everybody, right, to have their own individual department goal that support this goal. So we call meeting. Hey, finance, what's the budget? What's the plan? So when I hear from finance, I must know finance the coming year, what is your goal that support this? And your goal, what is your budget? Is it too much or too little, or you're doing something different? Okay, you're doing something different. Let's say, for example, if this goal is for old people, finance department is not going to ask money to have a children hospital. Does it make sense? Understand? Okay, does it make sense? Pharmacy, what's your goal? Try to get cheap generic drugs from India for old people disease. If the pharmacy have their own goal to buy young people disease, okay, no meaning. Okay, no meaning. Are you going to buy sunblock? Is pharmacy some pharmacy going to buy sunblock for old people? No, old people don't have sunburn one because they escape from the sun. So pharmacy must buy diabetic blood, diabetic medicine or something like that, Alzheimer medicine. That is how you make the budget. Where am I now? Okay, so this must be set correctly. And then identify key incentive is the department level, how the department level goes to support this goal. Okay, then they will develop how much money they want. It's the budget. Then the company will allocate now resources. What is resources? Resources is time, money, manpower, technical know-how. These are some of the examples. Okay, the company, the hospital don't have unlimited money. The hospital don't have unlimited doctors. So sometimes you need to allocate. And when you do allocate, you must now see if all of them are following this goal, which one is more important? Which goals of the department are very important to support? Those not so important to support, we cut off. That's all. So we allocate resources, then we see the actual compared with the plan. That's how we monitor progress. Is that clear? You guys are going to do this kind of thing in the future. You know what for you study MBA, healthcare. Any question?
No questions.
No, sir, understand.
Okay. The rest,
Hmm.
type of budget.
Okay.
Huh? Somebody say something? I don't know. Okay, pre-budget, strategy planning, then drafting the budget based on this strategy planning. Okay. Here, under strategy must do from forecast, forecast your sales, forecast your expenses, but the revenue and expenses actually follow the plan. What is the goal? Then after that, you create the budget, you use the budget, you implement, you monitor actual versus budget. Anything wrong, maybe budget need to change, or actual is so terrible that your budget assumption is wrong. Now, when you see very much difference between actual and plan, maybe here is wrong. Not because you cannot achieve the budget. People get the idea. When actual is different from planning, so much terrible the actual. It's not sometimes because of the fella cannot control. It's because this strategic planning was wrong. Your external internal assessing was wrong. Your selection of what goal based on the external and internal is wrong. Right? Therefore, you cannot achieve. Okay. Let's say, for example, very common outside, very common one. The strategy plan was wrong. So they implement. They didn't know it's wrong. They implement. So sales was no good. So you know what they do? They sack the marketing manager, bring in the new marketing manager. So the new marketing manager faced the same problem, that the original plan was wrong. So cannot do, sack the second marketing manager, bring in the third marketing manager. You understand? Or it can be the pharmacy manager. The plan was wrong. So you sack the current pharmacy manager, you bring in a new pharmacy manager, the flow also cannot implement because the plan was all along wrong. And the problem is, the one who's making strategic planning, the CEO, he don't want to admit it's wrong. He only admit that you cannot perform. So the CEO say, you cannot perform. Nothing to do with him. He was actually the one who created all the mess because his plan, his objective was wrong. And you guys, when the plan was given to you, you don't accept that plan. You understand? You don't accept the plan. The plan is too crazy. The plan is not realistic. You know. But you keep your mouth shut. Why? Because you still need a job. You haven't got a new job yet. Correct? You still need this job. So the boss say this, you do. At the end of the year, you cannot do, you find some excuses. Or you will be sacked before the year income. Where's the issue? Top people issue. Not your issue. So you need to convince your boss to set the correct plan. So how do you set the correct plan? You need to ask your boss, the threat, external and internal, and you must have a lot of other people input for the external and internal. Go somewhere to have a brainstorming, the external and internal. Then your big guns sit down, look at all the various factors, then you have a good chance to make the correct objective. If this is not done correctly in the first place, all subsequent plan is wrong, all subsequent budget is wrong. It's unrealistic. Understand? Now, some of you are working. I believe some of you are working. I think you're familiar with what I'm talking about, right? I don't know how many of you people are working. Every year they give you a plan or budget or whatever it is. Sometimes you don't like it, but you must say yes because you haven't got a new job. And you are poor. That's why you need to work. So you just accept the plan. In theory, in actual cannot recover. What do? You sabotage, right? You don't have buy-in. You are not committed. You're not motivated, and you're thinking of excuses. And worst come to case, you're thinking of finding a new job. But before you find a new job, because you still need the current salary, so what do? You blah blah. You try to find excuse. That's all only. At the end of the day, the company cannot achieve whatever is correctly to be achieved. Okay? That in my class is the practical. Okay? I always teach practical one. I don't want to teach so much theory. Wasting time. Okay, operating budget, volume projection, you have to budgeting healthcare. No, okay, revenue, how much cost medical equipment, only budgeting healthcare. This is just an example only. So level 1, gross. From this gross, you can split out into various things like, okay, cost, patient care again. You can make split into T, surgery, service, or merger. You can split out all this lah. Okay, now all these figure, revenue, cost, operating, it actually come from the corporate plan. Okay, what to do? Sometimes you have a thing called a flexible budget. Okay, because of things change. Now, how often must you change your budget? In theory, whenever the corporate plan change, you must change your budget. Understand? So how often is the corporate plan change? Whenever the external and internal change drastically. When the external and internal change so much, you have to change your plan. So if the external never change, maybe your internal never change, you can have the same budget for the next 20 years. But if it's very volatile, suddenly COVID come, you have to go and change your plan. Suddenly the government increase SSD. You have to change your budget, your plan. You have to change your goals. Right? Suddenly the government announced, I can remember last time, income tax relief. If you go for medical, there's no relief. Nowadays, you can have relief. Later on, the law change, your father, mother, medical also can get relief. All these are opportunity for you. Right? You may have threats. Okay? Somebody build another KBJ hospital beside you. That will be a threat. So you keep on changing. So when the changes are so drastic, whether internal or external, you may need to change your plan. When you want to change your plan, you may have to change your budget. Sometimes small, minor, you just change your budget, small. If it's a very, very big change, you have to change your whole plan and you must change everybody's budget. It's like that. Okay? So don't think the plan is for 1 year. You'll be surprised. I used to work in a company, 1 year, 2 plan. First half plan, second half plan. January to June, 1 plan. July to December, second half, another plan. Okay? That we make 1 whole year in the month of November. You make in the month of November for next year, January to December plan, split into two half, month by month. Okay? Now, after 3 months, so let's come to April. April, we got January, February, March actual. January, February, March actual, and then we revise May, June, July, August, September, October, November, December. 3 months actual, 9 months revise. Because based on 3 months actual, we will know what's going on in the actual situation. We may have to revise the plan. So that was a company that I worked for, American company, okay, semiconductor in Malacca. When I working in Sony, it's a different 6 months, 6 months. Do 6 months detail, second half, grand total. No point. Because we cannot see 6 months away. That was the logic. First half, November, you make January to June very detailed. Second half, grand total figure just for CC only. Then around April, we make the second half very detailed. And next year, first half, 6 months. You just go like that. Okay, so different company. And each time you make budget, it is very critical. You see, the normal budget is by month. But production budget may be by day. Sales budget may be by day. Why? If the sales say, okay, tomorrow I want to have a big event, I expect sales to be very high tomorrow. Production must make today so the goods are available to sell tomorrow. In other words, many companies will make their sales plan and production will follow the sales plan. Production must always be completed 1 day or 1 week or 1 month before the sales, because we need to complete the product, only we can sell. You understand? Okay. So finance is the same thing. You have your sales plan. When will we collect the money? Maybe you collect the money 30 days later or 60 days later. 50% of the customer pay 30 days, 50% pay 60 days. So your cash forecast like that also. So your expenses budget. Sometimes we pay people 3 months, sometimes we pay suppliers 6 months. Right? So our cash forecast also will be different from cash received budget is different from cash payment budget. Add up together by month, that's the net figure for the month. Cash flow, enough money or not enough money? Not enough money, now go and borrow money. Find ways. Okay, so this is something called flexible budget. Capital budget. Okay, normally most company headquarters should set the target, the goal, and then throw it to you, the junior people, to think how to achieve that target. Like I say, or they achieve that goal, you make your budget accordingly. So we will call the meeting. Every department, hey, stand up. How much people you want? What level of people? Then what equipment you want to buy? What asset you want to purchase? Car, building, machine, whatever it is. Then the accounts department collect everything. Talk to HR department, next year salary increment, how much? So you project your salary, okay, based on salary increment. Project the money you pay for bonus, right? And then we will see the cash flow. If you make a loss in your budget, it's okay. It's okay to make loss in a budget in the short run, 6 months, 1 year. As long as your cash flow is still got enough money, or your cash flow not enough money, you need to borrow money. Why you make loss? Maybe it's a new product. Maybe next year is a terrible year, unemployment, but we cannot get out from that business. Whatever the reason, don't be surprised if you make a loss. Important thing is your plan correct or not correct? Some plan may actually make you loss. Good example is Amazon. Amazon had been making loss many years from the very beginning, but their plan was very good. Their plan was so good that they go to the bank to borrow money, they go to the investor to have shares, they get the money because their plan was very good. So even though they make loss, people still lend them money. And the cash flow was lousy, but people still give them money. And after that while, a few years later, Amazon turnover is one of the richest company in the world. Don't get panic if your budget is a minus sign. Important thing is your plan. And if your plan is good, see, when you go and borrow money from the bank will ask you what? Balance sheet, income statement, the past one, to see the trend. They will look at the accounting ratio to see how efficient you are. Then they will look for your plan, because you are borrowing money for future use. So if I'm the bank, I lend you money, what are you going to do? They want to know your plan. Now, your plan will come back from the external and internal. You explain to the bank, we recognize this external, we recognize this internal, how many years or whatever it is, this year, this block of 3 years is this type of opportunity, another 3 years, another type of opportunity. You must make the plan. And from that plan, you will tell them what is the individual department strategies. And individual department strategy, and this is the budget, the income, the balance sheet, and also the cash flow. Now, the bank will have the information. Historically, what have you been achieving? The trend. In the future, what you plan to do? Because the future is very important. If your future is correct, you can pay me back the loan and the interest. If your plan is not correct, in the future, you cannot pay me back. So why should I lend money to you now? That's the key. You understand? So whenever you need money, you don't need money tomorrow, you ask now. You have to go and plan 3 months or 6 months. So some people, they already want to expand the business. They need to borrow money. So what they do? Now they do something to make their trend looks nice. They chop some people away to show better income. Then they make very good external, internal, make good plan, make good budget, go and convince the bank to lend them money. Understand? They don't run business as per normal. Suddenly, oh, not enough money, we go to borrow money. They already plan ahead what they want to do. Because if you don't plan ahead and you don't tell people what you're using the money for, people do not know will you be profitable or not. If you are not profitable, why should I lend you money? Because you cannot pay me back. That's the key. Okay. So the rest is not so important. This is a key for, this is variance, compare actual with budget. When you see a lot of actual versus budget, no good. First step, don't scold the manager. Don't scold the manager why you cannot achieve. You're not performing. Look at the background. The original, external, internal, the original, how they come out the corporate strategy. Because if that is wrong, of course the actual will be very much different from what you plan. That's all only. Okay. So every time the HR say must have KPI. Right? So this is a plan, okay. We give you this plan, we give you this budget, this is your KPI. If you achieve your KPI, okay, you can carry on working, maybe we give you a salary increment. Okay. But if you don't achieve your KPI, well, we're gonna sack you. Then what do? Oh, I will try to achieve my KPI. You know why? Because I haven't got my new job yet. I still need the salary. So, okay, I will reply. End of the year, what happened? I think of excuses why I cannot fulfill my KPI. The reason is because the plan is wrong, right? And now you are in the trouble. So you come up funny reason. End of the day, if a lot of people don't achieve their KPI, the company is not going to make a lot of profit. Very simple. Right? Very simple. Okay? So when you see actual very much different from variance, go and see your plan. You may have to change your plan. Okay? Change your corporate plan. Change your budget again. Okay? Not because the flood is not performing. And the worst thing is you kill them by KPI. I think most of you know what is KPI, right? What's wrong with KPI? They measure you half a year, they measure you once a year. It's always measuring against you. It's always your actual performance versus the KPI. That's the wrong concept. The correct concept of KPI is the manager, if subordinate do not meet their KPI, it's not the subordinate fault. Understand? Practically speaking, if the subordinate cannot meet their KPI, it's the boss fault. Because the boss maybe set the wrong KPI, didn't train to achieve KPI, select the wrong employee for the wrong KPI. That's the issue. Correct method is, correct KPI come from the strategies. The strategy will tell you what are the correct KPI. You can feel for yourself what is the correct KPI if you got a correct goal. And once the KPI is set up, it's a manager's job to train, to monitor every day that the KPI is achieved. KPI achieved is not equivalent to promotion or salary increase. KPI achievement is to meet the goal of the company. I want to repeat. KPI is not to promote or penalize the employee. KPI is the responsibility of the boss to make sure the KPI is achieved so that by achieving KPI, the strategy is achieved. Okay? So how do you promote people? That's a different class. Okay, how do you promote people? How do you give salary increment? Forget about KPI. Another class. So far, understand? These are all practical. Okay, where are you? Who is that? Class monitor. Are you
Yes,
still with me?
doctor. Yes, yes.
Okay, so that should be cover the budgeting. Okay, so it's not just budgeting for the fun of budgeting, or somebody throw you a figure that you have to go and put in a budget, and then funny thing, I tell you what's the funny thing. I make the budget. If I don't spend next year, I cannot get. Huh. If I overspend, I must think of reasons. Okay, I give you an example, very simple example. We see the actual versus budget. Hey, why actual so much overtime? Why so much overtime? Ask the fellow, why you so much overtime on against your plan? Oh, the day power failure lah. So our people cannot work lah. So they have to work on Saturday and Sunday lah. Extra. So we have to pay more overtime. Reasonable? Yes. What should management be thinking? If this is very constant, why do we buy a generator? That is the action that must come from the variance. Not scold the burger. Hey, reduce your overtime, reduce your overtime. Management is supposed to think of ways to solve the problem. Okay, another example. Hey, why you got so much overtime? Hey, the nurses are new lah. So they need more time to do their nursing job. So we have to pay overtime. Hey, why we employ so many not so good nurses? HR, why you employ this kind of people? You know what HR say? HR will say like this. I employ cheap nurses because it's cheap. It makes me, the HR manager, achieve my KPI. Because the HR KPI become achieved, medical staff have to incur overtime. Okay. Or another example. Okay. Patients are unhappy. Why? Drugs. Medicine not the correct one. Why? Purchasing by cheap drugs. Why purchasing you buy cheap drugs? Oh, very simple. I'm purchasing manager. I want to achieve KPI to reduce price of medicine. So purchasing is a hero, and the hospital department were having problem. So sometimes when you have actual versus budget of variance, that variance is not because of the manager problem. It's another department who create the problem. Okay, but most cases it's because the head wrong goal. But it can be other department that cause you to have problems. So you need to analyze. That's why you have budget meeting, actual versus budget every month. Every month you must have this meeting, and you must, when you call the meeting, you don't call one by one. You call all the managers in one big room, and each one of them, please explain your actual versus budget. That means the accounting must come out the actual versus budget report very fast. We used to have 1 day closing. Within 1 day, the accounts can be closed. So today is 30th, 1st of March. 1st of April, the accounts is ready. 2nd of April, report come out to show the actual versus budget. 3rd of April, we give all the managers to find excuses with 1 day. 3rd of April, we have a big meeting in front of the CEO. I will call out manager by manager, show the thing on the slide. Hey, why hire? Now, another curious thing. If you are very much better than your plan, we also want to ask why. Not only if you're bad variance, favorable variance allotment, we want to ask why. Maybe your budgeting was too lenient. We need to adjust. So too bad also we want to know why to solve. Too good also we want to know why. Okay, so that is how we do budgeting in the practical way. Now, who is a very important person? The strategist. Because he's the one who's going to convince the management to come up with the strategy. And he must know all the other departments. That's why we have people called executive director or senior general manager. They know everything, external and internal. So they can straight away point out where is wrong and how to solve as soon as possible. If your accounting report come out on the 15th of the next month, that means that 15 days, the old mistake will carry on. Therefore, we have more cost. If your accounting can come out the report within 3 days, we have a meeting. So the next month, you only have 3 days, not so good situation. But if you got 15 days, that means you 15 days, not so good situation. Because if you do not identify the problem and you do not take the action, the problem keep on recurring day by day. Okay. Okay, here comes the question. Mohammed Sulaiman, are you there?
Yes, doctor.
Okay. Have you got experience with budgeting?
Sorry?
Do you have experience with budgets?
Not that much, but I have, yeah.
Oh, okay. So somebody give you a budget you have to follow?
Yes, sure.
You should follow lah.
Yeah.
Who give you the budget?
Sorry?
Who give you your budget? You make yourself or somebody, your boss give to you?
No, make myself.
Oh, okay. How you make your budget then?
First thing, I see how much I earn per month. Then, and how much I need to spend on the main things like food and transportation. These are the main things. Then I manage compare my how much I earn and how much I need to spend, and if I need to make more management about deduct my spending, so I need to manage it. Then after that, I will see how much uh, will left, and if I can make earning per month, so I will keep some money for emergencies.
Okay. So the first line is you need to forecast how much you can get, correct?
Yes.
Where you get the figures to forecast? How you forecast how much money you will get? Your sales, your
Yes.
revenue.
Yes.
How do you do that?
Sorry?
How do you forecast what is your sales revenue?
How I can focus?
How can you forecast your sales revenue?
I can't hear you, doctor. Sorry.
Okay, not so good. Vanita, can you hear me?
What I can, sorry,
Okay,
what?
you say you must forecast for your sales, correct?
Yes.
How do you do that?
First things, I use sale data first.
Who give you the sales data?
Me?
You make your own sales data.
No, I could first thing, I see the data from the previous sales number, and then
Correct.
I make similar and continue.
Yep. That's the most common. You look at historically what was the figure, so you just add 10% or you minus 10% like that lah. Correct?
Yes.
So you're not looking at the corporate goals. Nobody tell you what's the corporate goal, so you forecast whatever you want to forecast based on your feelings.
Yes.
Does that sound reasonable? Because today you're feeling very good, so it's 10% up. Tomorrow you change your mind, it's 10% down.
Yeah.
It's your feeling.
But I can make the average for example, for the last 3 months, I make average.
Oh, again, it's your feeling. So, have you ever considered maybe with the new goal, I don't need your department? Oh, correct. So, depending on the goals, I keep on saying depending on the goals. So, let's say your hospital now got few department. Blood test department, X-ray department, Okay? Physiotherapy department. So you people carry on doing your normal job, year in, year out, and you budget accordingly. But if the corporate plan say we cannot do MRI business, or we will subcon out the X-ray business, you cannot make the budget for that particular department. You understand? It's not that, oh, last time we have been doing like that, we carry on doing. What happens if the corporate objective, let's say there's a huge threat, an X-ray company just set up beside you, X-ray clinic. You are not competitive. So the strategy say you must close your X-ray department. So what are you telling me? I will still carry on making my budget based on what I feel? You cannot. You can only make budget based on what is the strategy. If the strategy say we'll shut down the X-ray department, that's it. X-ray department no need to do budget. X-ray department just die.
Yeah.
Understand? Many
Yeah,
people do
understand.
budget because of historical. That's all. It's historical like that.
Yeah.
Boss complain, okay, this year we increase budget 10%. Boss complain little bit, okay, we increase 20%. If boss complain, not so much complain, oh, we don't change the budget, the last year figure budget. We maintain the budget. What happens if the strategy say you have to close off the department? But you guys will keep on budgeting, right? That's all. That is wrong. I suggest you think carefully what is the external and internal, and then think what should be your objective, your goal. And from that goal, what are the budget or individual department activities should be? Okay. If we have a children hospital all the time, Malaysia population now become lousy. No more new babies. Very little new baby is born. You know, like in Japan, very few babies are born. So your company will shut down the child hospital. Increase the physiotherapy department because old people keep on falling down. Right? Because of this, because of the strategy, some department will close down, some department will increase. And that's where the budget will be coming from. Okay? Not because you think. It's because what is the external and the internal. Okay? Do you understand what I'm saying?
Yes, doctor. Yes.
Another 10 or 15 minutes. I just want to do one last chapter. We call this the revenue circle. What is revenue circle? Registration, coding, billing. Now, one of the major problems that is in the healthcare, if you are dealing cash, no problem. Understand? Customer come, customer pay. Long customer one, pay deposit first. Got insurance or no insurance? So if you got insurance, okay, fine. Right? If you got no insurance, all right, bring out your credit card first, pay some amount, and then keep on topping up. Right? Until the day you get discharged. That is called revenue cycle. Problem is those people with insurance. Now, patient that's working in a company and the company got a medical insurance with, for example, I don't know, Great Eastern or AIA or Zurich, okay, or Mitsui Insurance or Taisho Insurance. So there are many insurance companies. The insurance company, please understand, they don't want to pay you, even though you buy insurance. Even though the company buy insurance, the company employee go and see your hospital now must go and claim against the insurance company. The insurance company don't want to pay you. Why? Because every dollar the insurance company pay you is every dollar the insurance company have lesser. And don't forget, insurance company also company that want to make profit. So you, the hospital, will do billing to the insurance company. Make sure your coding, because some insurance company will ask you to allocate what code. If you put the code wrongly, or you do extra procedures, they're not going to pay. So the billing department of the hospital, make sure you're on time, make sure you're accurate to the nearest one. Nearest bandage also must record nicely. You know how to go and bill people, right? Okay. So let's look at this very fast. Revenue cycle, scheduling, registering, charge, capture, claim submission, remittance, posting when you receive the money, denial handling. Insurance company deny you, you just lost the money. And patient collection for cash. Okay. Convert clinical activity into cash efficiently, of course. Okay. If your department, most likely the collecting money one, the accounts department, if they are very effective, compared with one department not effective, difference is 3 to 5%. Your sales amount. Some procedure you never bill, money gone. Okay, money gone. So registration, patient examination, coding, what they are doing, charge entry, claim submission, payment processing, chase the money, patient billing, if they're paying cash, collect all the money, then that is your revenue. That's about it. No big deal. Yeah. Now, there are some important index. Okay, you are going to be administrator, so you better look at it carefully. Historically, net days in accounts receivable. People don't pay cash. Those people will pay you on credit. Should not be more than 45 days. Why you have accounts receivable? Why don't everybody pay cash? No. Some people is going on insurance, right? Okay. Somebody is going on insurance. They don't pay you cash. Okay, they pay maybe a little bit that's above the claim amount. So those amount that people owe you means you cannot use that money. And you cannot use that money if you got nothing to do. If you have collected the money, you put the bank, you collect maybe 0.2 or 0.3% annual interest. And that bank money saving or income is gone. So general guide, not more than 45 days of people owing you. Okay. So let's say, for example, your total sales 365. $365 million a year. One day is 1 million. What people should owe you should not be more than 45 million. Okay? Yeah. So if you have 365 million people owe you, no, 365 sales, 365 sales a day, what people owe you should not be more than 45 ringgit. Okay? Cash a percentage of net patient serving revenue must be more than 55 as much as possible. So you like people who pay you cash or at least pay you by credit card, right? Hopefully more than 55%. So you only have exposure or risk 45, 100 minus 55, only 45% risk. Okay? 45% risk is not 45 days. We are talking about different thing here, okay? Discharge, not final bill. Do you have people like that? You discharge, but not yet the bill come up. Yes. You know, sometimes a private hospital, right, about to die already. You know what the private hospital do? They send it to the public hospital. Hey, people are going to die already. They send it to the general hospital. That's all. So you cannot finalize the bill yet. Emergency, they already in the ambulance go to the public hospital already. So private hospital say, hey, basically you die over there, so don't die here or else our name no good. Okay? Terrible. So denial rate by volume not more than 5% by the insurance company. And cost to collect. So sometimes you have debt collector or you have your own department. You should not be more than 3% of your total sales amount in the hospital. Okay, these are key performance threshold. You can use this one as a guide to compare what is your actual activities right now in the hospital. If any one of them is no good, think about it, why it's no good, how to solve. Okay. Never mind. Registration, coding, billing, all this no problem. Huh? The 1% rule. Each 1% rise in upfront eligibility accuracy, lower back-end denial. You know what's back-end denial? About the chabut already. You want to get out from the hospital already. He will complain. He will complain that, oh, I didn't receive this procedure, you still charge me. Okay. So if you have this upfront eligibility accuracy, what do you mean by upfront eligibility? You check really got insurance policy or not. You check when you go into the credit card, whether the credit card, the money come in or not. Okay. You see, if you're a hospital, when people give you a credit card, you slot the machine, you don't get the money immediately. The visa will take you maybe 1 or 2 days to reach to you. Okay, so you have to make sure that the money come and not rejected by visa or whatever the reason. Okay. How to enhance robot charge capture process means as soon as possible you do something, you enter into the bill, so the bill will be up to date. Okay. Use some automatic tools. Okay. Outcome, minimize error so that people won't forget to bill. Okay. Conduct regular staff training, because the staff is the one who's going to give the service or give the medicine or give the injection or the bedding or the whatever thing. So we have to train them to go and do billing. Now, in normal hospital, everybody is busy. The nurses are busy, the doctor is busy, they have done some procedure already, they have done some acting already, they are being called to the next job. And they conveniently forget that this job, they have not put in the bill. Okay. Now, in many hospitals, what they have is have a job order number. One patient, one time come in is one job number. And each job number, anybody who do anything, they will put in the cost into the job number. The hours lah, the supplies lah. Okay. At the end of the day, you can print out the job number, what is being done, and then you put the accounting department put in the money, and that is the final bill. Okay, so you need to train your people not to forget to put in what they have done or what they have given in the job number. Okay, outcome, enhanced compliance, document charges within hopefully come out. In most cases, we would like to come out before the fellow get out. Okay, from the hospital. Okay. So wallet deductible must pay before insurance start paying. Co-insurance, patient pays after insurance. Payment plan, option to pay in installment instead of one large amount. There are many ways of doing. Okay, many ways of doing. So it depending on the hospital, I cannot say. So upfront charity. Upfront charity is not so popular here. Maybe in developed countries. Okay, it means identify patients who qualify for financial assistance before treatment or at registration, instead of after the bill is unpaid. So when the bill is unpaid, then the blogger beg you lah, I got no money, this and that. So it's a little bit hassle lah. So many overseas hospital upfront, they already check. Okay, we will give you the discount. Are you happy with it? They even tell you upfront. Okay, so they look at the people, the insurance status, the family, a lot of people want, so no money want, because the family need money to eat. Eligible for government or hospital charity programs or grants. Okay, so sometimes can receive a discount or free care. This is not very common in Malaysia. Okay, in a certain developed country, yes. Okay, propensity scoring. How likely a patient is to pay their medical bill? They look at the past history. If this fellow had come before to a hospital, and in the last one, he pay on time. If he doesn't come and pay on time, right? So maybe you say, oh, we will do gentle one, or maybe you go another hospital, something like that. Yeah. Okay. Patient register, system check charity eligibility, run a prospective to pay based on historical record, or if they got Visa card, means they okay lah, they can sure pay, okay? But maybe their Visa card also got a limit, isn't it? Right? Patient is grouped into a payment category. So each payment category will have different way of thinking or how to treat. Okay, often the right option upfront to pay. Okay, so example, estimated bill 5K. Low prosperity to pay and low income. This fellow is a poor fellow. Maybe can get approved or major discount. If it's medium, he's not so bad, not so poor. We offer a long-term installment. If he can pay, a rich fella, Visa card. So you can see, if you are some way, they always look for this one. If you are Asunta, sometimes they look for this too. Okay, depending on hospital. Okay. Timely billing in the insurance claim form. Now, normally insurance claim form will ask you to put code. What kind of procedure, what kind of code will be subjected to what kind of payment insurance. Why they use code? Because the insurance company in the computer system already got all the wonderful code, so they don't have to calculate case by case. So when you submit with the code, they just key in, and then they will say whether it's okay or not okay. Okay? 1 day delay in payment from the insurance to you means 1 day you have lesser use of that money. Okay. Billing, patient billing statement design, all this normal but give lah. Huh? Okay. Please replace the hospital bill with plain language statement. Don't give a lot of medical jargon. Okay. Show what you owe. Self pay. Sometimes you give credit one 0.1% interest, 24 months plan, 2.5% interest prompt payment discount. 3, sometimes you got credit card on file auto pay. Okay, these are the self-pay collection strategy to encourage people pay. Okay, claim management, tackling insurance claim. You can submit to insurance. Again, the insurance people don't let you pay you one. So you better submit correctly, or they'll find excuses to delay you. That's all only. Okay, very, very simple one. 98% is your target. That when you submit your claim to insurance, insurance will not hold you back. They will pay you 98%. Sometimes you got 2% because your people do the coding wrongly, or you do extra procedure. Okay, that's why your insurance policy, actually, the insurance company already group what kind of category of you employee. That's why the insurance rates are different. And different group entitled to different room rates, different surgery limit amount. Okay, so it's like that. Okay, tracking government claim status. Government is the government money lah. Okay, so it's quite cheap one. Okay, so we don't have to worry too much about this. Okay, denial management. This one, insurance deny you. Why? For small reason also they deny you one. Because they don't want to pay the money. A denial because when insurance refuse to pay a claim either fully or partially. For example, a hospital may treat a patient and submit a claim, but the insurance reject it due to incorrect coding of the claim. Now, every insurance company got a different coding code. Okay, so please use the correct code. Missing authorization, okay, of the form. Patient ineligibility, okay. If not managed properly, this become lost revenue. So you have done something, but insurance don't pay you. In the meantime, the patient run away already. You cannot claim for the patient. Okay. Denial root cause taxonomy can be caused by registration, authorization, coding, documentation, extra clinical procedure or wrong clinical procedure, and payer policy. Payer is in this case an insurance policy. Okay. Coding errors in surgical cases are a common cause. Okay. Prevention, flag claim with 60%, deniability probability before they are sent. So you need to predict which claim got a little bit of problem. You solve the problem before you submit to the insurance, because you wait for the insurance to deny you, this is time wasted. Money is coming late. Okay. Appeal. So you want to appeal to the insurance company, go ahead. Time. Okay. Cash flow, nothing much. Bucket. Your statement should show insurance company how much they owe you. Due 0, 30, how much they owe you. 30, 60, how much they owe you. 60, 90, how much they owe you. So whatever the total bill that you claim for the insurance and the insurance have not paid you, it can be sorted by dates. If it's a long one, 91 or 120, this is really a problem. Why they're taking you 3 months to 4 months to pay you? You have to go and talk to them personally and see what's the problem. Be proactive, go and visit the insurance company, not over the phone, because these are money. Okay? That's about it. Okay? We have finished chapter 7. So I don't know, maybe some of you will be involved in the revenue cycle. Okay, just remember about this particular chapter. Okay, and here I have written you some guidelines how to control money coming in, because no money, your cash forecast are a problem. Okay, hang on. Is there anything else? Wait, hang on. I want to do one more because I got seems to have more students coming in, 18 students. So far, anybody got anything they want to ask me? Anybody want to tell me? Anybody got any problem?
No, sir.
Doctor.
You all can do your assignment.
Yes.
Okay. Then do it by the 20th, please. Okay, and you need to pass all your assessment. You need to have maximum 60 marks. You need to have 30 marks grand total. Okay. Now, in the meantime, hang on. I want to stop the recording.